Stephen Dorrian of CBOE. In fact, that's an interesting start point. You guys like to be referred to as CBOE rather than CBOE. Have I got that bit right?
Yeah, you have. I mean, I think our CBOE was originally an initialism for the Chicago Board Options Exchange, given our heritage.
Yeah.
But over the years, CBOE has really expanded through various acquisitions. It bought the old BATS and BATS Chi-X companies. It bought the Neo Exchange in Canada, as well as various others. So we're now across 27 different markets, across 5 different asset classes. So we had a rebranding exercise a couple of years ago to CBOE Global Markets to kind of de-emphasize the options and bring in the fact that we operate these global markets around the world.
And at least you didn't do what Aberdeen did and remove all the vowels. So you could actually say the new. Sometimes marketing people get a bit carried away, but I think your one.
Well, we've got two of our 4 letters are vowels, so that would be quite an awkward one.
That would be a bit difficult. By the way, don't worry about the fuzzy screen. That will all be sorted out in the editing if you're seeing a fuzzy screen. I am. So actually, we almost started doing the introduction that I always do. As I said, I will put your LinkedIn, your personal LinkedIn, on the description. I will put the corporate website for CBOE Global Markets as well, so that people can look those up. You've already started giving a little bit of a hint about CBOE. Give us a little brief. Who's Stephen Dorrian? Where did you come from?
Yeah, so I have worked at CBOE now nearly 7.5 years. I'm responsible for CBOE's European market data and connectivity business, essentially all the non-transactional commercial items. And I also have a responsibility for business development across CBOE's Data Vantage business. So Data Vantage has 3 kind of strategic pillars. There's market data and access. That's the kind of proprietary data and access to our 27 markets around the world. And then we have our CBOE Global Index business, really specialist in derivative-based indices. But we also distribute a lot of partner indices as well as our proprietary CBOE indices. So we distribute the likes of the S&P 500. We have FTSE Russell indexes on there, as well as MSCI Morningstar and some crypto indexes. And then we have what we call our platforms business, or our risk and market analytics. And these tend to be exchange agnostic. They're not just for CBOE, they are market wide. And they include order management systems, execution management systems, as well as real-time analytics. So we have that part of the business as well.
I'm getting tired just listening to that. It's a lot on your plate. I think that it's a segue into one of the things I wanted to chat about. I think CBOE is an unusual, maybe even a unique entity as an exchange, because you tend to get the exchanges that are classic cash equity, London Stock Exchange, New York Stock Exchange, Deutsche Börse. I mean, those are classic equities exchanges. I know some of them also have some sort of futures sort of on the side, etc. But you guys, I think, are the most diverse set of markets. Is that do you think anybody else even comes close to the diversity of all your different markets?
No, I think you're right. I think we're definitely the most diverse in terms of asset class, but also geographic coverage.
Yes.
I mean, even if you just think about our equity segments, we operate 4 equity markets in the US. We've got 2 in Canada. We have 1 in the UK, 1 in the European Union. We've got Japan, and we have Australia. When you look at the kind of the market capitalization of those countries, it represents a very significant part of kind of worldwide equities. So very distinct in that case in terms of our broad coverage.
I mean, an unfair question, and I probably could look it up in annual reports, but I mean, roughly how much is equities and how much is options? I mean, again, roughly. I mean, don't worry if you haven't memorized that, but...
I certainly haven't memorized it. We are majority derivatives.
We can look it up on the annual report. We'll look it up.
Yeah.
I'm going to do that. Questions do pop into my mind, so I haven't warned you about every single one. But I think again that diversity of geography is an interesting one because I when I look at the exchange landscape, and oh gosh, I've been in this industry 40 years and I've seen it evolve. I remember when the exchanges were sort of owned by the big brokers and jobbers, and it was a very different market until they all demutualized and became private companies, which in its sorry public companies, which in itself has affected their behaviors in different ways. But again, you used to get a very specific national exchange. I think Sally Ann Taylor said, look, every country wants to have a flag, an army, and a stock exchange. It was like a symbol of national pride. And the country would all focus on that local exchange. And again, in the early years, not that I'm a big investor, but it was really difficult to invest outside of your local market. I mean, most people, most individuals, I don't know about institutions. What I'm getting at is you're unusual in the sense you've broken that mold. MiFID, I think, to some extent, sort of was the regulation that pushed that forward. But I believe one of the rules, I think that might have existed before, was the old concentration rule. Was that what it was called? When exchanges or countries were allowed to say everything has to be on our local market. And that's, I mean, where I'm teeing up is a big sweeping discussion about the landscape of exchanges.
Mhm.
How have you seen that from where you're sitting? Both you were at London Metal Exchange, a very different type of exchange before, and then CBOE. How's it evolved? How's it changed? I would characterize you guys as disruptors. Is that a fair? Do you see yourself as disruptors, or do you have a more polite, not polite, that's the wrong word, a different euphemism for it?
No, I think our DNA has definitely been in the disruptive side. I think SIBO, in the options exchange part of the business, has always been, it's been going for 50 years. It was
Yeah.
the first ever listed option, and it's been innovating consistently. It brought the volatility indexes to the market and allows firms to express an interest at a position across the US market. But through the BATS global market and the Chi-X acquisitions, those firms really started their life as disruptors.
Yeah.
And you've mentioned it already, David. MiFID 1 back in 2007 introduced the pro-competition framework that is now embedded across Europe. And that allowed multilateral trading facilities to merge, and that led to secondary trading of liquidity. And ultimately, it led to lower trading costs because there was a lot more competition. So you used to have the national markets with the concentration rule, and as you said, if you wanted to trade a German stock, you did it on the German Stock Exchange. If you wanted a UK stock, you did it on the London Stock Exchange. What MiFID 1 did was really just introduce competition. It opened up these, as I said, MTFs, multilateral trading facilities, and that allowed the secondary trading of these instruments. So regardless of which exchange had the initial public offering or the listing, the trading of that security became admitted to trading on all of these other venues. And you had a lot of MTFs emerge at the time, and certain ones fell by the wayside, others became very successful. And what is now CBOE and was previously BATS in its previous incarnation was one of those. And if you look at now across market share, I think on Friday we were 26% of all lit trading across Europe, and that's across 18 different countries. We are typically the largest exchange on any given day by the amount of volume that gets traded through us. And that's typically a symptom of being the second biggest in any individual jurisdiction of which one we operate. So the UK market, someone like the London Stock Exchange might have a 60% share. Somebody like a CBOE has 30, and then you have other venues fill in that gap. So what that's led to is competition in trading. It's also led to innovation in trading mechanisms to give investors choice. So if you think of the history of CBOE and BATS, we launched the first dark book after the first kind of MTF lit book. We then pioneered periodic auctions that now represents more than 5% of all pan-European trading. We facilitated large and scale trades for buy side who are maybe worried about information leakage and they want to get trades done at size. We we launched an alternative kind of closing mechanism called CBOE Closing Cross. And then just a couple of months ago, we launched CBOE VWAP or Trajectory Cross that allows two firms to agree to trade at a future price. So you've had this proliferation of innovation and choice in the European
Because I
markets.
suppose you, bluntly speaking, you were coming from behind. Being a disruptor, you've got to be different. You can't just come along and say,
Yeah.
we do exactly the same, come to us. You have to be different to get people to switch. And I suppose the good thing for the market, I presume, some of the more entrenched, established players, I suspect copy some of your idea. I mean, that's the nature of competition. Some good idea gets innovated by one person, and after a time, others also introduce it.
I think that's right. Um,
And that's healthy. I mean, that's good. That's the way markets should work.
Agree, and we think it's good for the market. We bring these things to market because typically our customers have asks for them. And then we typically see our competition, something very, very similar. I mean, periodic auctions, great example. Now most of the other MTFs offer it. Same with dark books. You now even have the national markets offering dark books as of this year and towards the end of last. And there's also now a couple of announcements about future VWAP venues that are potentially coming, whereas SIBO was the first to bring that to market.
Help me out, educate me a bit, because I remember, I don't know if it's still the case, there was this, you mentioned MTFs, multilateral trading facilities, and then there were quote unquote regulated markets. And my simplistic understand was regulated markets were regulated more than an MTF. I never quite understood that. Did that mean it was dangerous and worrying to deal with an MTF or not? I never got that impression, so I wasn't quite sure what that distinction actually meant.
Yeah. So the difference mainly was around whether or not you had a listing facility, so you were bringing new companies to
Right.
market for fundraising and capital raising, versus purely the facilitating of secondary trading
Got it.
of instruments. But it's worth noting that actually many MTFs are also regulated markets.
Well, I've observed that happen over time. So
Correct.
technically, I mean, SIBO you don't list. You have never listed. Are you entitled to list if you want?
Yeah, so SIBO globally is actually one of the largest, and actually we are the largest in the US ETP issuer. So we are a primary regulated market for exchange traded products, exchange traded ETFs, and we are the premier destination
Right.
for that. We also have listing capabilities through our Canadian market and as well as our US equities market, actually. So even SIBO as a stock is listed on a SIBO equities market. And in Europe, we've announced our intention to develop listing capabilities under our regulated market segment. But at the minute, it's predominantly ETPs in the European sphere, and it's also ETPs in Australia. So, yes, we essentially view it as
Yep.
two segments within the exchange. We have the regulated market segment where we have primary issuances, and we have the MTF segment, which is the secondary trading where the issuance has occurred on another market. But the books are very integrated in how you trade those.
I mean, one criticism, if that's the right word, of the emergence of you, not personally about SIBO, but about disrupting these national exchanges and what have you, is fragmentation. That's the sort of, the choice is the positive word, and fragmentation has a slightly negative connotation. It almost implies dilution, or, oh, I've got to go and look all over the place to, you've made my life more complicated. Wasn't it nice and simple when I just had one exchange to go to? I mean,
Mm.
do you have, is that conversation still going on? Is that in the past of history, or do people still voice concerns on that front?
I think it depends who you ask. So you look at something like the US equities market. It is by far the biggest equities market in the world. And they have 16 US equity exchanges, and they all trade the same stock or ETF. You can access Apple across all 16 exchanges. And in many ways, it's fungible. And because of the best execution rules, you have to essentially route to the market with the best price. Uh, Certainly when we speak to our customers, they are very, very keen on competition. They feel that it improves investor choice and they want that choice based on their preferences. I mentioned, the block trading platforms earlier, the dark books. those are all used very, very heavily because they achieve an execution outcome that the customer wants. Now, I think this is probably a good segue into what one of the things that the consolidated tape is trying to solve. So Europe's
And we're
pro
into the
competition.
data because we've been talking about exchanges, but data's our business. You and me, Stephen. So
Yeah, and like that they are so intrinsically linked as well, right? Data shows what is happening in the trading world. So if you think we've mentioned MiFID and the introduction of these alternative venues. So Europe's pro-competition framework post the dissolution of the concentration rule has meant lower trading costs for firms who want to trade because it has that competitive pressure. So that's been fantastic. You alluded to it. There's some people would view then the introduction of fragmentation as a slight negative because there are now many venues or exchanges where a firm can buy or sell shares or ETFs within the European Union as well as within the United Kingdom. And so if you're a firm to source the full liquidity, it can become a complex and cumbersome task because you have to source that from multiple exchanges. And if, for example, you're a firm and you're only consuming something like the national stock exchange data, you're only seeing 50 to 60% of the on exchange liquidity. You're missing 40% of it, and you're also missing almost an equivalent amount of notional going through on the OTC market, whether in a true bilateral fashion or through systematic internalizers. Um, so that you miss a large part of the market if you so you do need that picture, you need that stitched together, that fragmentation, and that's where the idea of the consolidated tape has come in. So there will be three consolidated tapes in Europe, a different operator per asset class, equities including ETFs, fixed income, and then derivatives, and specifically OTC derivatives. So I'll refer mainly to equities just because
yeah,
I think it's been the more interesting one over the last couple of years. But the idea behind the consolidated tape is that you have one appointed entity that will be regulated, whose sole job is to consolidate the market information from all of these exchanges, MTFs, and approved publication arrangements, or the APAs, that publish that OTC trading data for the purposes of transparency within the European Union. Now, what's that going to do is it's going to give investors and firms a view of the best price available in the market for any given security. So we call this the European Best Bid and Offer, or the
yeah.
EBBO, and a full list or tape of all trades in the European Union or the UK, regardless of which venue they were executed on. And it's also going to have all of the OTC trade reports, so you get a full liquidity picture. What this is going to do is simplify sourcing of market data because what it does to the outside world is it presents Europe as a single investable universe, and it can show the true depth of liquidity available in the European Union. And the hope, I think, from the European Union is that this added level of transparency and simplification of that consolidation, it just will allow firms to assess whether or not they want to enter the market. And then once they do, they will, of course, buy data center space. They'll probably buy the proprietary data feeds, but it helps them get a flavor of what's going on in Europe before they invest significant capital to establish themselves in the market because data is always the precursor to
But
trading.
playing devil's advocate on that, and again, this conversation's been going on and on and on. And there's a lot of confusion. There's a lot of disagreement, but actually, I think also a lot of confusion as well. And one concept that was bandied around was, well, hang on, the consolidated tape is already there. All the aggregators, what was Refinitiv and Thomson Reuters and Bloomberg, there was, you could go and get a consolidated view of the entire European market. So what's the difference between that and what is being proposed built by the regulators?
Yeah, no, it's a good question. You're right. So from a technical perspective, consolidation has always been there and always will. The main difference here is that there's going to be a single appointed consolidated tape that will be fully regulated versus a commercial entity like a vendor that is maybe
Yeah.
not regulated. And to ensure that this is different and it achieves the simplification aspects that we discussed, the idea is that exchanges are not allowed to charge a fee for their market data to the consolidated tape operator once they have been appointed by ESMA or the FCA in the UK. Instead, they will give their data for free The CT, or the consolidated tape, will consolidate that, and the exchanges that contribute to that will get a revenue share that is based on market share, as well as a couple of other factors such as listings, whether the price is from a pre-trade transparent mechanism, or whether or not you're deemed to be a small exchange. So it encourages competition. And the hope then is that because the consolidated tape doesn't need to produce the data, it doesn't need to operate these highly resilient, robust exchanges, it doesn't have to buy its data. It means its costs are much more narrow in scope. It's restricted to the consolidation of that data. And therefore, in principle, they should be able to offer it at a lower cost point than exchanges. And certainly if you consider, the sum of the parts, if you buy all the individual contributing venues, and also it's going to be under a single license. So the exchanges cannot impose pass-through terms or licensing restrictions. The consolidated tape operator, once appointed and regulated, will define its own licensing and pricing structure, and it will be bound by cost of production plus margin, which is called reasonable commercial basis under the regulation. And that will introduce competition, may drive down costs for data in Europe. I think there's certainly some hope for that. Um, but also, I think interesting is, sorry, just one last point that would be there's also going to be for the first time competition around the closing prices. So the closing price is still very much an advantage incumbent European exchanges benefit from because they operate the closing auctions, and in the absence of a consolidated tape, they enjoy a dominant position in the provision of market data to the institutional community who really need that closing price at the end of the
Right.
day. So the closing price will be on the consolidated tape. So I think that inclusion is going to really lead to quite an interesting competitive dynamic across Europe because for continuous trading, you have multiple sources. You have MTFs and everything else that we mentioned, but the closing price is still very much exclusively the domain of the listing market.
Help me out here. Is that linked to the NAV, net asset valuation, that a lot of funds have to do, used to do once a day? Was that often based on a closing price? Am I
Yeah,
picking up
lots
the
of
right?
people would correct. Lots of people would mark their portfolios against the closing price, especially like kind of passive funds that are tracking an index. So it's why you see quite a large proportion, especially around index rebalancing of the daily notional in Europe, getting done in a closing auction. Whereas continuous trading, from when the market's open on the lit books, there's a lot of competition there and there's a lot of choice for data, but the choice is slightly limited towards the end of the day unless you're willing to wait 15 minutes. And so the competition angle of the consolidated tape, introducing that alongside continuous trading data, alongside a simplified licensing proposal, and most likely a lower cost point, I think it's just going to be an interesting dynamic going forward in the European market data landscape.
So observing that, so we're going to have future tense, imminent sense, a European consolidated tape for equities. We have seen for many, many years there was a US consolidated tape in the US, which again, I love the way the Americans would call it, not the US best bid and offer, they would call it the national best bid, as if there was no other national. I should never dig at my American friends. I'm 1/4 American. So you've got the European best bid and offer, but again with the US tape, as I remember tapes, and there was always this. Exchanges had a whole data business, which has matured over many, many years recently. And the idea of proprietary data, of data added value products, you mentioned earlier on, we're going to talk about that the core consolidated tape with best bid and offer is an essential sort of anchor point if you're trying to track markets and stay on top of markets. And for a large proportion of a market, it's maybe enough information for them to be making decisions on, etc. But then there's a much more sophisticated part of the market that wants much more sophisticated information, has got much more sophisticated strategies, etc., etc. And exchanges, as I've observed, have a whole range of sophisticated products, added value products, proprietary products. Can you talk me through, I mean, how does that all play out? Obviously with a CBOE angle, but yeah, just try and describe that market segment, if you will.
Yeah. So the US is interesting because it's certainly different from Europe. what you have had in the US is you've had a consolidated tape for near on 50 years. In the 70s, they established the Regulated National Market System, or Reg NMS, and they introduced their SIP, the information
Yeah.
processors, securities information processors, which is the same name as our consolidated tape. And every exchange provides data to that tape. And I think it was really almost before the proprietary data kind of business models emerged in the US. But what you've seen is there's two kind of fundamental differences, I think, from Europe to the US for where that market has come from and is going and has and is. Firstly, there is a mandated consumption of the US consolidated tapes.
Ah,
So
yeah.
every firm has to use the consolidated tape national best bid and offer for their best execution obligations.
So these are
Um,
brokerage house who are regulated in turn by the SEC.
Correct. So there's something called the vendor display rule. At the point of execution, you have to show your customer the last traded price, regardless of which market it was on.
Yeah.
And the NBBO is used for order writing to ensure you're meeting your best execution obligation. So you have mandatory consumption of the consolidated tape, which means you have a captive audience for that data. Conversely, in Europe, there is no mandated consumption, and the best execution is more of a fiduciary duty, but it's not pegged to a particular benchmark. So you don't have to connect to every venue, even if another venue has a better price. You just have to make all reasonable steps to achieve best
Yeah.
price for your customer. So in Europe, when the consolidated tape launches, nobody has to buy it. So it has to be based on value to the customer versus the alternatives. And the other way I think it's going to be different is in the US, the consolidated tape is actually the most expensive data choice out there versus proprietary data products. So, one way, for example, CBOE's added value in the US market is because we operate 4 of the 16 markets, we essentially create a mini consolidated tape. We take the best prices across all 4 CBOE markets, all trades. We also then add enrichment data to that, such as the national open, high, low, close price across the day, regardless which exchange it happened on. And we show the cumulative volume across all 16 exchanges per security. So what that does is it gives certain firms and certain use cases an alternative to the consolidated tape where perhaps it's a far lower cost point, the data quality is equally there, but maybe there's also more flexible policies and there's enterprise license fees that can represent quite significant savings. On the European side, conversely, I can't see a world where the consolidated tape in Europe is priced more than the sum of the proprietary data products. So I think we're going to have a different dynamic where the consolidated tape is probably going to be the cheaper product on the market. I think there's also going to be obviously the pan-European products like from CBOE that I think will probably be cheaper or at least more competitive and have maybe more data on there. But you're going to have a different dynamic. In the US, consolidated tape higher priced than the prop data. In Europe, it's the inverse. I think consolidated tape will be cheaper than at least the sum of that fragmentation.
So what are customers going to buy beyond the consolidated tape? And as I was saying that, I realized actually there needed to be nuance to my question because there are different types of customers. So I think different types of customers. If you're a hedge fund, if you're an institutional asset manager, if you're a stockbroker, there's lots of flavors, and I suspect they've got retail broker. They've got different needs and wants. So what is going to happen beyond and outside of the consolidated tape? What is the market activity? What sort of products and services are going to be happening out both from yourselves and the wider market?
Yeah, good question. So,
Very sweeping question.
very sweeping indeed. I guess one thing we haven't touched upon actually is the content of the European consolidated tape actually as
Yeah,
well, and how that
yeah,
differs from the US. So, in the US, you know which market is at that best price. In
right.
Europe, it's actually going to be unattributed. So you're going to know what the best price is. You're just not going to know where to get it.
And
So
why
that
does
does
that
limit.
matter? Why does that matter? Because if I know that's the best price, is the idea if I know where it came from, I could go and get it? Is that
Cor- Correct. I think you can, certainly from a best execution point of view, investors can hold their brokers more accountable if they see, maybe there's a better price on somewhere like a CBOE, but maybe their broker isn't connected to that as a venue. So, and I think just from a transparency perspective, to understand which venue is at the best bid or the best offer across Europe, it improves transparency and it's good for the market. But equally, it can open up additional use cases. Whereas if it's just an anonymous EBBO, it's certainly an indicative of where the best prices are in the market, but not necessarily the price you may achieve. So it will limit some of the use cases across the consolidated tape in Europe, which in and of itself is interesting. Whereas in the US, you know exactly where it is, so it's almost a like for like top of book product. Um,
Well, you just used a phrase there, top of book. I mean, the concept of a best bid and offer is at the top of an order book. An order book has got all the bids and offers going down, including their volumes and whatever, because there's a whole load of extra information lurking there. If the best bid and offer doesn't have much volume behind it, then maybe it's not that meaningful. Am I mixing concepts up here? I'm just trying to put myself and imagine the people sort of hungry for this data. What do they actually want?
Yeah, it depends on you. I mean, like you're not going, any firm that is looking to place orders will most likely need the depth of book. They need to understand where the interest is at multiple price levels,
Full
not just,
depth or just because there's sort of partial depth and then there's full depth.
yeah, I think it depends on the customer. There's been arguments and requests for the consolidated tape in Europe to have 5 levels of depth, for example. I think consolidating full depth is tricky when you think about how many levels of price there may be in the market. But the vast majority of use cases, certainly I think top of book is sufficient because it represents the highest bid and the lowest ask, and therefore it's the best price you could achieve in the market. So from a transaction cost analysis, post-trade analysis, understanding your best execution obligations, displaying a price that is indicative of where the market is at to retail across a retail brokerage platform. Top of book tends to be the product that they use. It is more the sophisticated firms, particularly those that are directly trading on exchanges, that would typically need the level 2 or depth of book data. So that is one, I guess you could argue it as a value add product that other exchanges would offer, distinct from the consolidated tape, because the core data that the consolidated tape has is only going to be top of book or level 1, the best bid and offer. And that's the same across the US and Europe. Now, you mentioned how else can exchanges add value. I think there's a couple of ways, right? Firstly, there's informational value in the data itself. Okay, so you know you take something like CBOE Europe's feeds. They contain 50% of all the trades in Europe. When you look across on and off exchange, that's a large part of the liquidity picture that helping firms decide where to invest their capital, and that value is derived from the fact that we run and invest very heavily into running robust, resilient, and regulated markets and help with price discovery. So there's value in the data itself. However, going beyond just the core exchange output, I think exchanges can add value a couple of ways. There's probably product price policy and leveraging the entire exchange ecosystem. And I'll maybe explain that
Yeah,
last bit.
do.
But if we start with the product, I mentioned CBOE1 earlier, where we have a consolidated feed that looks at our 4 markets, brings that together, stitches some of that fragmentation of the US market together, and offers a competitive choice against other proprietary products as well as the US consolidated tape. There's also the idea then you enhance data, so not just consolidate it. So if we look at something like our Hanwick product, we look across the entire US Opera or options universe, and we calculate Greek's theoretical prices and volatilities across that entire universe, across all the strike prices. And that requires an immense computational power, but it provides firms the ability to power their trading decisions and risk management. So you can layer over analytics on top of the core data.
I mean, are
Um,
you competing with data aggregators who might be adding that layer because they take your data and add value to it? Are you beating them to it by adding it before it comes out?
no, I mean, any exchange can license data to do similar, or any
Yeah,
vendor,
yeah.
sorry, can license similar. And in fact, CBOE are the Hanwick product I mentioned there, that's calculated off the Opera feed, which is the
Yeah.
options consolidated tape. That's not coming off proprietary CBOE data. So anybody could do that, but it's certainly a value add. If you think about what exchanges can do that maybe data vendors can't, is they can lay over additional information on top of that core data to provide insights. So again, a good example of this is we have our CBOE open close data set, and it's for our 4 US options market, but we provide volume summary reports and break down the type of flow based on the originating firm. So you get a volume summary report by how much of that flow was market maker, broker, dealer, customer, professional customer, as well as buying and selling positions and how they started and closed the day. So that trading activity analysis can also help firms understand the market in a way that maybe just the unattributed or the anonymous aggregated market data can't. I then mentioned price. I think this one's relatively self-explanatory, but I think again, going back to the US equities market, good example where there's more than 16 exchanges, and in many ways the data has become commoditized or it's fungible across venues. So pricing comes into play here as consumers then have choice for where they source it. So exchanges can be more aggressive on pricing and offer more choice. And then an extension of price is, the licensing restrictions. How flexible is an exchange and what you can do with the data once you purchase it? And I think exchanges can add a lot of value by understanding their customer's business model, understand what's important to them, and take those business models into kind of consideration when they design a policy. So, one example could be having a retail brokerage program that lowers fees if you're a kind of a new entrant, but ultimately caps at an enterprise level. So retail brokers have certainty over their cost, even if only a proportion of their funds are actively traded. And then I mentioned bringing in the ecosystem, because data is one part of an exchange's expertise and capabilities. But when you start to bring in the entire exchange ecosystem, you can add a huge amount of value to bring new investment products to the market and give investors choice. So if we try to bring that to life with an example, in the US, we have seen a significant trend in recent years for the rise of defined outcome ETFs. So these are ETFs that incorporate derivatives into their strategy, which means they can offer upside participation but downside protection. So what they do is they achieve this by incorporating options into their strategies, and you can sell puts on stocks that are in your portfolio to limit any downside if the market moves against you. So versus a pure equity exposure where you're exposed to the entire downside if the stock drops. So where does an exchange like CBOE fit into something like that? We call it the flywheel. There's data into indices into tradable products. That generates more data, cash trading, derivatives trading, and then it's a virtuous cycle. So firstly, the derivatives or the cash equities core market data, that can be used as an input into an index. Our global index team then use their expertise and knowledge as leaders in this space to create these derivative-based defined outcome strategies that they encapsulate as an index. Then, if you're a consuming firm, if you're an issuer, you can create products using these indices, and they can be the underlying to your exchange traded product. And then you can then equally list those on someone like CBOE to help facilitate access and the liquidity to these instruments, and to give your investors known ETF product wrapper that encapsulates an option strategy that might be kind of viewed a bit more sophisticatedly. And then you can have options on the ETFs, and the trading of those ETFs themselves, and the index generates more and more data and more information for the market. So you have this virtuous cycle leveraging all capabilities across the exchange to bring something truly new to market.
And I think in a simplistic way, what you're saying, what I'm hearing from is there's plenty of things that exchanges can do. If the core consolidated tape part of their classic data business is slightly changed, perhaps from their perspective for the worse, there's a lot of other stuff, a lot of added value work that they can do. You can do, but your competitors, other exchanges as well, can do as well. Can I pick up on something you mentioned? And again, it's something I don't think I really understand properly. Another one of the, I think it was in MiFID II and things that have gone beyond MiFID II, the RCB, the reasonable commercial basis part of the regulation, which I don't think is. It's in addition to the consolidated tape. Simplistically, I understand it that it's the European Union, ESMA, their machine for that, saying exchanges, when they charge for data, should do that on a reasonable commercial basis. And what they mean by reasonable commercial basis is it should be somehow on the concept of cost plus a reasonable margin. I'm not arguing the rights and wrongs of it. What is it? But rather than arguing whether it's right or wrong, could you help me out here? The audience what is reasonable commercial basis? What do they mean by it?
Yeah, and I think you summed it up well. It's defined in the regulation as the cost of production plus a reasonable margin. And there's some other aspects to that. For example, you have to have a price list on your website. You have to give at least 90 days notice. Everybody has to pay the same fee, so you have non-discriminatory access. And exchanges have to publish public cost disclosures about how much their data costs to produce, what percentage of their total revenues market data represents, and whether or not they're applying a margin. So all of the data is public and it's out there for firms to look at.
But how can I help me out here? I get a bit struggle with this margin concept because these are digital products. They're not physical products. With a physical product, you make something and it costs you £10 all the components and £5 of labor. And therefore, if you charge £20, you've made £5 of profit margin or whatever. But with a digital product, you create it, music or a video or a podcast like I'm doing or something. There is a cost to production. You could identify, the physical components and the time and the effort and everything. But the beauty of a digital product is, I could charge 10 people £10 each, but 20,000 could watch. How do you calculate a margin for a digital product?
Yeah, and I think that is fundamentally where some of the complexity and maybe subjectivity comes in. Because you're right, for digital services, there is in many ways a fixed cost base. Now there will be variable components to that. There's hardware, there's energy, there's different fees we have to pay our suppliers, and they are going up based on inflation or just annual renewals, things like that. So there is a cost to produce the data.
And there's an argument just about what the cost is, but I'm not focusing on that. I mean, you could argue about what the cost is, but that's not my point. It's once you've agreed on the cost.
Yeah, so we've always argued that reasonable commercial basis is a good proxy for the regulators to monitor developments within the market data industry. Because if there is an explicit cost, we have to disclose that to our regulators, and there's also then revenue tied to market data, and the sum of those two things is the margin, or the difference of those two things is the margin, and provided that is reasonable, I think the regulators have a good view of how it's been charged. Now, I think where it's become slightly more subjective or difficult in the past is if you have a fixed cost business that has some variable components to it, but there's not necessarily, as you said, we're not producing a physical item in the way you would have a unit price. So you have to decide how you recover those costs. And that is across a broad spectrum of customers who are all using the data in different ways. Like it may be the same price to produce data for, say, a retail investor as it is to produce it for a tier one bank. But equally, you are not going to apportion that equally across those two because they're very different. One's a firm, it covers all affiliates, and one's an individual. So exchanges price around that concept, and they take into the fact that some costs are joint with maybe the operation of the trading exchange, but equally that there are direct costs to facilitate the creation and distribution of market data as well, whether that's personnel, servers, the multicast feeds, things like that. So the question then is, if you have a largely fixed cost base and you have 10 customers or 1,000, do you just divide the cost equally amongst them all? And a lot of exchange revenue growth sometimes can come from also organic growth. You bring on new firms. New firms are interested in the US market, for example, or the European market. People want to buy their data. They become more aware of different markets. There's a spike in trading activity, as there has been the last few weeks with the tariffs, and suddenly the European markets are getting more attention. So it's a bit of a balancing act. I think it's a great proxy to ensure exchanges are charging reasonably for their fees, but to get overly prescriptive um, can present challenges. So there's a couple of changes coming to the regulation that will be take effect February of 2026, and it just really expands on the concept of the reasonable commercial basis, and it introduces a couple other factors. So it's now added that each exchange can only charge each client once, so they've got a per client model for charging. They have said that each client can only fall under a single category, so you cannot charge them multiple fees. So perhaps in today's world, an exchange would be charged a customer maybe for two distinct use cases. Maybe they have a retail platform and they have a redistribution license for redistributing that data to their customers in real time. But equally, maybe they're operating a systematic internalizer, maybe they're using the data for algorithmic trading. So there's also typically a non-display component. Under the new regulation, exchanges have to come up with a single category for that type of firm and charge once. So I think exchanges are still going through the analysis of how they are going to meet this new regulation. And the regs have also been more prescriptive this time around what costs are eligible for inclusion in that cost of production methodology. And it identifies typical costs that can be considered joint and or direct. And any joint costs need to be apportioned between the trading business and the data business. And they're trying to standardize these cost disclosures, what we call Article 11 disclosures, and there'll be more information provided to the regulators.
Stephen,
So,
I'm we're 46 minutes in. Um, this
uh,
this is exactly what I wanted, by the way. I think we might have to have a round two because I've learned over the years. I mean, this is a very emotive subject, and I think we're both. I hope we're avoiding that emotive side to it. Um, and there's arguments to and fro, and I believe strenuously that the biggest problem with all this is it's very difficult to understand. It's very difficult to follow, and I think half the battle is not arguing whether it's right and wrong, but frankly just trying to work out what it is. And you've been very helpful in doing that. We haven't covered it all, so we the reason I'm sort of drawing that particular bit to a close because there's a couple of other things that I think in our last 10 minutes we should try and touch on more broadly. But I again I would love comments from the audience. I would like to have you back because I think you're very good at explaining this. Because frankly, I dip in and out of this. I sort of understand it, and I read some long ESMA document, and then I forget about it for 6 months. You're living, eating, and breathing it, so you you really understand it. So, I mean, I think there was a sort of segue out of that anyway into two words that I've written down on my list, and maybe we just hit them together: complexity and compliance. I mean, the overall observation, and it's come up multiple times on my podcast so far, is there is a despair almost on the customer side sometimes about dealing with a particular exchange. That particular exchange has a complicated policy, but then there's 200 exchanges have equally complex but different ones. So just wrestling with that complexity makes it very difficult for them to comply. Now, we've talked about this on FISD committees and meetings and events. I'm not expecting you to solve it in 6 minutes, but I mean, what are your overarching thoughts on that issue we as an industry have been wrestling with for 20 plus years?
yeah, it goes back to, as I mentioned earlier, the design considerations an exchange has on its policy, and sometimes complexity gets layered on as new use cases emerge and perhaps old
With good
definitions or terms
intentions, with,
with good
good
intentions
logic.
potentially. Yeah, and look, not every exchange is the same as well. Worth pointing out, I know exchanges that have price lists that are 60 pages long. If you look at CBOE Europe, it's a page and a half. Anybody can understand it. You don't need to be a market data expert. So you know, there are exchanges out there that I would argue have simple policies, but you're right. I think the complexity comes in sourcing from global markets where perhaps there's no standards or no standardization across the policies. So I think that in itself adds complexity. Um, and I just mentioned that the new RCB regulation is going to require exchanges to charge once per customer. So to me, that's also open to interpretation. You may see exchanges interpreting that as the traditional kind of use case licenses we all know today, non-display or distribution. But equally, if you have more than one use case, exchanges might be thinking, well, I actually now need to come up with a new category that covers that. So it's a category based on the client segment. It's a client based on, the combination of uses. So if anything, I think this could actually take us further away from something I've heard in some of your other podcasts around why is there no standardization?
Or common
So
language. I think people,
common language, yeah,
because standardization somehow implies everybody doing things the same.
yeah,
Common language seems to suggest let's call things by the same name. Is that?
yeah. I think that's fair. But I mean, if we take two examples, CBOE has tried to aggregate its 27 markets under a single global data agreement to simplify that consumption. But one of the challenges we have is local regulation may require the treatment of data or a term in a certain way. So in the US, it's very common for the non-professional or retail user definition to be aligned with that of the US Consolidated Tape. And it essentially says you don't have your Series 7 license and you don't work for a financial institution and you're not trading on behalf of anybody else. In Europe, that definition is slightly different. It's typically more if you're trading in a personal capacity. It doesn't matter if I work for a bank 9 till 5, but if I'm investing my own money through a retail broker platform in the evening, I am a non-professional or a retail user. So you have regional differences for a start. And then ESMA, for example, in their market data guidelines and now in this new RTS, have actually included standard definitions that exchanges should use in their policy. So there is now a definition of non-display, and there is a definition of distribution and display data and so forth. So exchanges, if they haven't already incorporated, will incorporate those into their policies, provided they are subject to MiFID. So it's going to be the European
Yeah.
exchanges. So that will help with standard terms, at least within the European Union. But it's the top level term, right? It's non-display.
Yeah.
Then, if you look at the exchanges, and depending on how they categorize from February of next year, they typically have multiple subcategories, whether it's you're acting as a principal, if you're operating a trading platform, if you're acting in an agency capacity. So it's fine to say non-display is broadly the use of data that is not for eyeballs or terminal usage. But when you get into the policies, there's maybe 5 variations of that on a
It's a
given exchange.
matrix. It's a matrix, really, isn't it?
It is, and that's evolved through various use cases. I mean, we've had requests for firms who want to tokenize equities and put them onto a decentralized finance, network. That didn't exist 5 years ago. And actually, the licensing restrictions around something like a distribution license doesn't work when you put it onto the blockchain. So there will always be an evolution of policies as use cases evolve. But equally, sometimes there is complexity that could be simplified. And I think CBOE is a great example of that. But if you also try to hold everybody to the same standards, it can actually stop you being maybe more competitive, cheaper, having a simpler policy if everybody has to go to the same level. So, for example, there's the term device in ESMA,
Yeah.
whereas for in CBOE Europe, for example, what we saw from our customers is they actually would rather pay on which underlying market they were in. So if you're a Nordic broker and you only care about the Nordic countries, you would pay us for the Swedish, the Norwegian, the Finnish, and the Danish stocks rather than paying on a per device basis. And we find that suits our customers a lot more. So making sure there's still an element of flexibility for exchanges to do what's right by their customer, that is, I think, a big key
Because
decision to ensure there's competition.
that's where I've detected it. People are uncomfortable with the concept of standardization because it seems to limit their flexibility. That is where I sense there's a tension because if you're going to force me to standardize, and that means I can't apply some of my clever ideas that do this. So I think this story is going to run and run and run. Look, we're sort of nearing the end, really nearing the end now, and we haven't touched on whole swathes of what we could have touched on. But as I mentioned at the beginning, if there were a couple of really burning points that we haven't covered that you really wanted to cover, now's your chance, Stephen. Final thoughts. And again, I know we haven't talked about everything.
Yeah, no, like there's a lot more we could talk about. I mean, we didn't touch on kind of changes of consumption, which is also a way exchanges can add value. So, what we've seen, for example, is customers more and more want to consume data directly from exchanges, but also through the cloud, not necessarily having data
Yeah,
center
yeah.
presence. We've seen a huge demand from and a global interest in firms outside the US accessing the US market, just given the outperformance of stocks like the Magnificent Seven. So there's lots of things exchanges can do to help facilitate
24 by 5 is another thing that's
24 by 5. We didn't even mention that. You're right. There's been this growing trend towards 24 round the clock trading, particularly of US securities. I
yeah.
think Europe's some way away. I mean, I don't know if you remember, David, but years ago there was a consultation paper out about shortening trading hours and whether we should be closer to America or Asia.
Yeah.
Now the argument or the line of thinking in the US certainly has gone to 24/5. So, CBOE has announced it will be there day one. We already operate some of our derivatives round the clock, so we're 24/5 on a lot of our options and futures markets. So we have the technical capabilities. But to tie it back to even some of the trends we talked about earlier, the US consolidated tape, it needs to make sufficient amendments to support overnight trading. And, so there's certain pieces of core infrastructure that need to happen as well as regulatory approvals before there's 24/5. But CBOE, as well as other exchanges, have announced their intention to be there day one. And so I think it's going to be another interesting evolution in the markets. And from a market data perspective, suddenly you're going to have market data for an additional 8 hours of the day, right? So more value being added.
More
And
market data. Yeah, you
exactly.
can't
And
have enough.
a lot of that trend has been driven by Asia, right? And it ties into
Yeah,
what I mentioned earlier. Like global markets want access to the US market. They want good quality data. And much like the European Consolidated Tape, they'll use this data as a precursor to trading. And they need to understand where the market is before they kind of fully partake in it. So it's a virtuous cycle. And yeah, the 24/5 I think is going to be a very interesting development. And it'll be interesting to see what other markets follow.
do you realize there's one thing you haven't mentioned?
What's
The
that?
two little letters that everybody else has managed to mention. And
You're
AI.
going to say AI, aren't you?
Don't worry, we're not going to talk about it. But I thought you were masterful in never mentioning AI, because everybody else, it's just on everybody's lips on every conference I go to. It's
I think I've avoided all the buzzwords except cloud.
Yeah,
So
yeah, you
there
got
you
that
go.
in. You got that. I'm glad. No, look, there's a million things, Stephen. This has been a true pleasure. You and I have known each other a long time, so I'm so glad we got the chance to do this. I hope if the series of David Anderson talking market data continues well, I'll have you back, or maybe I'll get Kevin Carra, your colleague out of New York, or there's so many people I could talk to, but I'm so glad I've spoken to you early on. So I am going to draw this to. So thank you for doing this, and I'll say cheerio.
No, thank you, David. Thanks for having me.